Good afternoon, everyone. I am Austin Kanoth, and today I'll be discussing sensitivity analysis as a tool for capital budgeting. As a quick introduction, we are going to talk about sensitivity analysis and how to conduct one. We'll then talk about how risk is inherent in capital budgeting analysis, and then tie the two together with an example of sensitivity analysis for capital budgeting. Sensitivity analysis essentially involves changing one independent variable at a time in a calculation to see how it affects the result or dependent variable. We have an example shown here that we're going to dive into later in the presentation. This same process can be used in capital budgeting to see how certain conditions could affect the profitability of a new investment. In the same sense, this can be used as a decision tool by managers and investors to determine whether or not to invest in a new project. Here are the steps involved in performing a sensitivity analysis. So first, we want to determine the data point to be analyzed. In this case, we have future value. Then we want to determine independent variables that affect the outcome. So principal, interest, and time compounded. Then we'll research those variables to see how much they could be susceptible to any changes and determine values for those variables. So here we have years in 5, 10, and 15. And interest rates of 8, 10, and 12%. Then we will conduct our quantitative analysis. So we've already determined our equation. We can determine the independent variable to analyze, years or interest rate, and then perform calculations with that equation. Once we've recorded our results, we can then go back over to qualitative and analyze those results. Here we see that our set changes in time had more of an impact on future value than our increments of interest rate. Now that we know how to conduct a sensitivity analysis, let's talk about how this can be used in capital budgeting. There are 5 major methods for evaluating investment projects, shown here. All of these are dependent on discount rate. Projects with a higher discount rate will have more risk, while projects with a lower discount rate will have less risk. You can see this visually on our NPV curve for both projects. As interest or discount rate increases on the x-axis, both net present values decrease and even become negative on the y-axis. By considering discount rate alongside our sensitivity analysis, we can paint a clear picture of probable outcomes for decision makers. So let's look at an example of sensitivity analysis for net present value and internal rate of return. We have our inputs here on the left. In this case, we're talking about a real estate firm selling houses as a project. Here we have our calculations used to determine our free cash flow. You can see that free cash flow equals operating cash flow, and this is only for simplicity's sake. Here we have our equations. You can see how both net present value and internal rate of return depend on our discount rate, WACC, and our cash flows. First, let's analyze how changing variable costs in our inputs can affect our net present value. So we have our inputs here, with our pessimistic condition being $100,000 for variable cost. We can see our optimistic condition of $30,000 as our variable cost, and how that affects our net present value. So in our pessimistic condition, we still represent a good investment with this project since the net present value is greater than 0. However, if we perform the same sensitivity analysis with sales and say we had a bad year in sales and only sold 300 houses in a year, we would add a negative net present value, which would represent a bad investment to decision makers. Here, doing the same thing with internal rate of return, we have our pessimistic condition for internal rate of return, resulting in 54% for IRR. This is a good investment once again, since our IRR is greater than our discount rate of 30%. In sales, again, we can see that if only 300 houses are sold in our pessimistic conditions, that our internal rate of return represents a bad investment, since 17% is lower than our discount rate of 30%. Decision makers can understand that the project could be a good investment, but it could also be risky in the case that we have a bad year of sales. In conclusion, we discussed what a sensitivity analysis is and the steps to conduct one, as well as how risk is inherent in capital budgeting, and then tied it all together with an example of sensitivity analysis we can use for capital budgeting. Thank you for your time.